We often hear about the stock market somewhere or the other. In newspapers, on TV, or from a friend who came from the city saying, "Bro, I invested in stocks," or "There's an IPO, I applied for it." But what exactly is an IPO? What is the stock market? Is investing in stocks profitable or risky? And what role does the stock market play in the economy? Let's understand all this with a small and simple example. Imagine you are running a small business, a food stall. To start this food stall, you invested 20,000 rupees. Your monthly revenue is around 100,000 rupees. After paying operating expenses, GST and other taxes, salaries for helpers, you are left with a net profit of 10,000 rupees per month. Since the business is doing well, you decide to expand. Along with the food stall near your house, you want to open another one near the bus stand. But to do that, you need more investment. And let's assume there is no one to give you a loan. So you approach SEBI, the Securities and Exchange Board of India. You submit your past 3 years' financial data, such as balance sheet, profit and loss statement, cash flow statement. Simply put, this data shows how much debt you have, how many assets you own, how much tax you pay every year. SEBI verifies all this information. If everything looks good, SEBI gives you official permission to raise funds from the public. Now, the public gives you money. In return, you give them ownership in your business, called shares. This process is known as an IPO, initial public offering. This is also called the primary market. The amount of funds you are allowed to raise depends on the size of your business and SEBI's approval. After 1 year, your business grows further. Revenue increases. Profits increase. You share a part of these profits with your shareholders. This is called a dividend. Now, people who did not buy shares during the IPO start tracking your company's performance. Once they realize the business is doing well, they want to buy your shares. For this purpose, SEBI and the Indian government provide a platform called the stock market or secondary market. An important point here is, in the secondary market, the money does not go to the company. It goes to the person who already owns the shares. Let's take a simple example. During the IPO, the share price was 100 rupees. Due to good profits and increased demand, the share price rises to 130 rupees. The 30 rupees profit goes to the previous shareholder, not the company. The stock market plays a very important role in the economy. In our food stall example, business expansion creates new jobs. Employment increases people's purchasing power. The government earns more through income tax and GST. Higher government revenue helps develop infrastructure. Better infrastructure attracts foreign and domestic investments. In the long run, all this leads to an increase in the country's GDP.